Dear friends, welcome to the May edition of Monthly Viewpoints. The month of April has seen consistent positive news flows which helped the markets put bottom in place, and we have seen that Nifty Index, the large cap index, has gone up 17 trading sessions out of 21 from 10,100 level to 10,700 level, clocking gain of 6.2%. As the risk appetite was back, we have seen that the Midcap Index was up 8.2% and the Smallcap Index was up 7.7%. Among the sectors, IT was a stark outperformer, as we have seen that the results from the companies were better than expected, and we have also seen that because of under ownership and a depreciating currency, people were looking for hiding place, and IT stocks provided that particular opportunity. The prediction of IMD for a good monsoon has augured well for the consumer goods stocks, which seen rally in these stocks during the month. India, which has been an underperformer year to date among the global markets peers, has turned around during this month and has performed well by a big margin compared to the other markets. The rupee has depreciated for third month in a row. The top of the mind on every investor is that the oil price has breached the $70 mark, and how would we impact? We have seen that the rise in oil price has in fact become an opportunity for equity investor. For the oil to increase 3 times in about 30 months, there are various factors. The first factor is that the OPEC and non-OPEC countries have come together to do a production cut of 1.8 million barrels per day in January 2017. Initially, the market expected that the compliance of this particular cut would not be maintained, but to its surprise, 100% compliance was maintained since the beginning of the agreement. It was widely expected that the US production increase would offset this, but over the last 6 months only, we have seen that the US has increased by 900 kilo barrels per day, which is much lower than the production cuts which this OPEC and non-OPEC countries are doing. The second reason why the oil price has gone up is because of the geopolitical risk in Venezuela, Yemen and Iran. Iran is particularly important because the deadline for reimposing of sanctions by US on Iran is approaching, which is 12th of May 2018. If these sanctions get reimposed, then we will see that a production cut of 250 to 300 kilo barrels per day would be there from Iran, which produces almost 3.8 million barrels per day. And over the next few quarters, we will see that this number might go up to 900 kilo barrels per day because of cut in technology, funding and offtake of production. So there is a risk lurking around the corner, and some amount of the risk has been priced in by markets as the Brent moved from the mid 60 levels to the mid 70 kind of levels. Because of this increase in oil price, the equity markets and bond markets are concerned about the twin deficits, the fiscal deficit. Because it's a pre-election year, there could be hesitation for the government to pass on the deregulated prices of petrol and diesel to the public. Hence, there's an impact on fiscal. Because excise duty could be cut to maintain the price in case oil goes up, there could be pressure on fiscal. The LPG and kerosene subsidies could also be stalled going forward, and hence the total impact on fiscal could be an extent of 30 to 40 basis points. Because India is a net importer of 1 billion barrels per year, a $10 increase in oil price impacts it by $10 billion, which is about 34 basis points of GDP. And hence, at mid 70 kind of levels, the current account deficit start looking at 3% kind of a number. To fund this current account deficit, only FDI flows of $38 to $40 billion are not enough. We need more flows in the form of FPIs, because of which our rupee can go into some amount of pressure. But the situation in India today is entirely different from what it was 5 years back or 10 years back, because we have forex reserves of over $425 billion, which can be put to use to tide over the volatility in case of one. In fact, equity markets investors should use any weakness because of oil price increase as a buying opportunity. Since 2000, we have seen 9 instances where oil price has gone up more than 50% and Nifty index on an average has given 28% return. In the recent up move from June 2017, oil price has gone up 70% and Nifty has gone up only 11%. The bond markets are confused by the dovish statement given by the Monetary Policy Committee on the policy day and the fear of RBI Deputy Governor turning hawkish going forward, as indicated in the minutes of the meeting. The 10-year bond had rallied 65 basis points post the policy day, but has retraced post publishing of minutes. On the macro front, the things are getting better. The GST collections for April came in at 1 trillion rupees, which was a significant landmark which the markets have been equally waiting for. And some of the concerns which markets were building in have been easing because of this particular figure. The February IIP number came in at 7.7% year-on-year growth, which was pretty decent. The IMD is forecasting a good monsoon, which should be a relief for both rural India as well as the broader markets per se. RBI in its policy has downplayed its forecast of inflation by 45 basis points for first half and 15 basis points in the second half, which should augur well for the policy going forward. We are early in the results season with only 17 Nifty companies declaring results, and we have seen that the sales growth and EBITDA growth has increased by 18% and 16% respectively, and net profit growth came in at 1%, which is quite muted and disappointing. But we'll have to wait for the entire result season to get over to come to a conclusion of something actionable. Coming to the actionable on funds, as elaborated earlier, there could be volatility in the markets. Make volatility your friend by committing capital on bad days, if any. If your return expectations are between 12 to 13% over the next 2 to 3 year time horizon, you would not be disappointed. Take exposure to any of our funds which are available in the equity basket, right from our large cap fund to multi cap fund to mid cap fund to small cap fund and thematic funds, depending on your risk appetite. From fixed income opportunities point of view, if you want to experience low volatility, then we have our host of accrual funds available for your investing. Thank you and happy investing.